Hey, it's Rob. Welcome to Everyday Investor TV show. Thanks so much for tuning in. We've been doing this show for 20 years and it's not changed. We want to help you grow your money. You see, the challenge often is we take our precious time, we go to work, and we're blessed if we have a job. We get a paycheck in order to eat. Let me say that again. We take our time, we go to work, we make money so that we can provide. But imagine a life where money could make you money. You could take your precious time, work a little less if you wanted to, and spend it with family, friends, engaging in a purpose that's greater than yourself. That is what this TV show is all about. Remember, when anyone offers you any type of investment vehicle, you want to ask 4 questions to start. Number 1, what's the return on investment? Number 2, when do I get that return along with the money that I've put in? Number 3, what's the minimum investment amount needed? And number 4, what is the risk? What is the downside? We've got a great show coming up. Don't go anywhere. We'll be right back. Coming up, we're talking to Chris and Rachel, and we're learning how to make money investing in apartment buildings.
Like, let's say we renovate a unit, modernize it, and put $40,000 into it. Well, did you know that we're actually increasing the value by $150,000? So we're putting in 40, making 150 in terms of valuation, and multiply that by 20 units. As you can see, the wealth accumulation is happening.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, 0 commission. Head over to our website, everydayinvestor.com, and find out more.
Do you love private lending, but are starting to feel like the passive side of it isn't as passive as it once was? Is running for bank drafts, wires, and constantly picking new deals taking the passiveness out of your passive investment? The CapCap Mortgage Trust has a lending solution for you. In our fund model, we allow you to invest across a pool of diversified mortgages, generating stable returns in a set it and forget it model. If this is the type of solution you have been looking for your private lending, make sure to reach out to myself and the CapCap team so we can help you.
Hey, it's Rav. A few years ago, I learned how to trade stock options by taking the Theta trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more. Hey, it's Rob. Welcome back to Everyday Investor. Today we're talking to my good friends Chris and Rachel, learning how we can make money investing in apartment buildings. Guys, great to see you. But Rachel, this guy, he doesn't look like Neil. I mean, usually Neil's on the show. We're talking about rent to own. So tell me right off the get-go, how did this come to fruition?
Well, listen, I think every real estate portfolio needs to have a bit of a balance with properties that are here for the medium term and delivering a solid, profit and a solid cash flow. But you also need to have a profit margin for the long term, building wealth. And that's really where apartment buildings come in. So I'm just balancing things out. Just using a different guy for it.
Nice. And then actually there's 3 of you, a woman by the name of Dahlia as well. And so the 3 of you have come together and diversifying. And here we are in the apartment building space. Chris, you were going to say something?
Yeah, no. It's we've got a really good mix between the 3 of us. So I've known Rachel for years. I've known Dahlia for years. So yeah, the apartment building and the long-term wealth building aspects of that, we're on board. We're excited for it.
Yes. I was talking to Neil and I was saying, Neil, how come you're not in the game? And he said, no, these guys are incredibly competent. I'm going to stick to the rent to own and go from there. So let's touch on that for a second, Rachel. How's that going? The rent to own strategy. I mean, it's a great one. I have friends that have investor friends that are doing it, thanks to you guys. What's happening there really quickly before we talk about apartment buildings?
The demand for rent to own is still continuing to grow. As you know, a lot of people are struggling to get bank qualification, and rent to own will solve that problem. And it's really for investors who want to invest with the purpose of helping someone get into home ownership and also create a lot of cash flow in the process. So that is going strong.
Okay, so here we are. Chris, people call this, in the investor world, we call it the multifamily space, but for, layman's terms, there's no difference. We're investing in apartment buildings. I guess the difference is multifamily could be technically, 6, 7 units, but it also could be 15, 20, 50. And so, I thought we'd just term it investing in apartment buildings. But talk to me a little bit about that asset class and why you guys like it so much.
Multifamily from a lender standpoint is technically 5 doors and greater. And where we focus is primarily 10 to 30 units. And there's a very specific reason why we're looking at that size of apartment building when we're identifying our signature. And so these are purpose-built buildings, right? These are the apartment buildings that you see driving around throughout the different markets in the GTA. We pick very select markets in the GTA. And part of the reason why we love this asset class is just because of how it performs in markets that are correcting, right? Like everybody has felt what the market has done over the last 12 and 14 months. And apartment buildings have stayed strong throughout that, not just because of the residential unit that they are, but because the asset class itself remains more stable through correcting times.
And Rachel, talk a little bit about the qualifications. I mean, I know that's a big reason why investors get involved, is because it doesn't fall on RAV to qualify. If I didn't return my VHS video to Blockbuster, dating myself, it doesn't really matter. It's because it's the income that apartment building produces is what the lender looks at, yeah?
Yeah, and I think after my experience with constantly qualifying for mortgages on rent to owns and other investors that, are in the trenches, you get exhausted. And as, entry level homes in our real estate market continue to climb, it gets constantly harder to qualify for financing. So, there has to be another way. And what I love about this asset class is that when you're buying into a building, you're really buying into a business, and a business makes money and you get qualified based on the business revenue versus your own personal, credit situation and your GDS and TDS. That's off the table here.
Yeah. No, it's great. And so you said, Chris, it's strategic that it's 10 to 30 units. Why is that?
Well, there's a couple of reasons. As we know in apartment buildings, there's economies of scale, right? If an investment that's a duplex, a 2-unit building, makes a certain amount of revenue, well, a 20-unit building is going to make 10 times that. It's not as linear as that, but it works in that way. So we get economies of scale. The other reason why we like buildings in that range, that 10 to 30 unit range, is we find that there's a lot of investments and apartments out there that are currently owned by one-off investors. And they're not necessarily running the investment like a business. And that's where we thrive, just like Rachel said. We're running it like a business professionally, and making sure that expenses are sustainably cut as low as they can and still running the building properly, and that the revenue is as maxed out as it can be. And we find that in that 10 to 30 unit asset class, we're not competing with the huge REITs, right, in acquiring these buildings. And we're not in competition with the smaller investors in the 6 units. Right in the middle is a sweet spot in terms of price, in terms of the opportunity to kind of make that business thrive, right?
You're right. We're not competing with somebody who wants just, a multiplex, if you will, 6, 7 units. We're starting at the 10. And then we're also not competing with institutions, right? We're talking to mom and pop who are not necessarily, and we'll look at some formulas that you guys look at after when we come back from the break. But, it's kind of, I don't want to say undermanaged. It's great for them, but there's other things and other ways that we can make money investing in apartment buildings. So we're here, this show is all about education to teach people different options if they want them. But you also invite investors. So people like Rav can invest with you guys. And so how does that work? Is it a joint venture relationship, which is really just a sexy word for partnership? And if it is, how does it work? Talk a little bit about the fundamentals, like minimum investments, generally speaking, how many different RAVs can come into the deal? Am I silent? which I'm sure you would want Rav to be silent, and what's kind of our exit, So talk a little bit about how it works as an investor passively.
Yeah, so great question. And the way we structure this, I mean, first of all, it's a truly passive investment, right? And so for the investor who loves and believes in real estate, but doesn't have the time, interest, or aptitude to be running these 10 to 30 unit buildings, this is a chance to, and you alluded to it earlier, to do passive investing without title qualifications, right? So that is a very unique opportunity. And to get into an apartment building that's typically inaccessible to most investors, right? So minimum investment, think around 100,000. That's not written in stone, but that's a guideline that we follow. And then in terms of that structure, it's a corporation. So the investor buys into the asset, the corporation that owns the apartment building itself. And to your point, they're a silent partner at that point. And it is very passive. And so that's the beauty of it, right? You don't have to worry about running the operational plan or taking care of the financing. All of that is done for you.
Yeah, and with my friends and family that have participated, they've also enjoyed the fact that you can use your home equity line of credit to invest, because sometimes it's hard to come up with just $100,000 of savings, and you can use home equity lines right now and put that kind of money that's sitting in your home to work to continue to build wealth. And the way that we have created the apartment building model is that you will be able to benefit from kind of covering the expenses associated with using your line of credit. And on top of that, you have a piece of ownership of a building. So as that building goes up in value, you benefit in the long run as well.
As the tenants are paying down the rent, as it goes up in value, and as you mentioned, something that's a little different, and we don't necessarily get into the details. People can contact you and find out more, but you also have a bit of a cash flow component as an option for people like Rav, if I want to invest, to be able to pay the interest on that home equity line of credit. Okay, so you shared already kind of the minimum investment, $100,000. Talk about return on investment, the possible exit strategies, and the risk when it comes to investing in apartment buildings.
Yeah, perfect. So as Rachel mentioned, there's a cash distribution. So that's one way in which capital is being returned. Second way is, as we're running this business and increasing the profit of that business, we're able to refinance the apartment building at certain thresholds in time. Typically, we would look at a refi within 3 years and possibly another one at the 5 and 6 year mark, where chunks of capital are then returned on top of that cash distribution. So that gives you an idea of how capital is coming back to the investors. And that's really critical, right, is that there's a cash flow component. And as that capital is being returned through those refinances, the equity ownership, as Rachel mentioned, is still within the investor's possession. That's where that long-term, possibly intergenerational, depending on the investor, wealth comes from.
Okay, so in terms of an exit strategy, not the only one, but one strategy is that we refinance, pull money out because it's increased in value. People are paying down our mortgage. So we can pull money out year 3, look at it again year 5. But really, Rav would get his $100,000 back, and that's the goal. But now this property is still making money. There's income that's coming in, and I get to enjoy that forever, pass it down to my kids or whatever. We would know this in advance, kind of the strategy that we're looking at. Yes?
And to that point, I mean, every time we have people leaving or renters moving out and we end up updating that unit and, like let's say we renovate a unit, modernize it, and put $40,000 into it. Well, did you know that we're actually increasing the value by $150,000? So we're putting in 40, making 150 in terms of valuation, and multiply that by 20 units. As you can see, the wealth accumulation is happening. So we're kind of working towards two things. We're trying to pay back capital for our partners and with a cash flow component as well. And then as that has been satisfied, we're also seeing growth. And the more tenant turnover we get, the easier it is for us to get that long-term wealth happening for the partners. And our partners in the deal own 50-50.
That's fantastic. Yeah, I mean, really, it's an infinite return if we're holding it. But in the first, 3, 4, 5 years, let's put a number on that. We're going to take a quick break. We'll look at the annualized return on investment, and then let's talk a little bit about the risk, and then let's kind of look at the formula of what Rachel just said. When you put, a few dollars in, why we know what it will spit out. There's an exact formula that has to do with cap rates, etc. We're talking to Chris. We're talking to Rachel. Don't go anywhere. We'll be right back.
Did you know that if you're selling your home or investment property, one of our preferred agent partners will sell it for you for free? That's right, zero commission. Head over to our website, everydayinvestor.com, and find out more.
Hey, what's going on? This is Kyle here from Kyle Ford Mortgages. On today with my better half, Chelsea. We have a very exciting announcement. You've asked, we've delivered.
We have a really exciting event, so mark your calendars, June 9th to 12th. We have networking, mastermind, some awesome content. We have a pool party, a beach party, a black tie gala. We've got it all, and you can rent your very own cottage or have an awesome room at the Kiwi Motel.
If you're looking for all things real estate, whether it's short-term rentals, long-term rentals, private lending, creative financing, whatever it may be, not only great content, but great people, good times. You absolutely do not want to miss this. Make sure you check out the link.
Hello, everyday investors. It's First Access Condos, and when you see me, it's pre-con time. What if I told you for only a 15-minute drive, I could save you 25% plus off the purchase price? Too good to be true? No, it is true, and it's coming to Scarborough on Kingston Road by Alltree Developments, Kingside Residences. Steps to the bluffs, steps to the beaches, and for a 15-minute drive, I'll save you hundreds of thousands. That's right. And what about the rents? Very similar to Toronto. What is that? Do I hear cash flow? Every month, baby. Reach out to us, and remember, First Access Condos. Don't be second.
Hey, it's Rav. Welcome back to Everyday Investor. We're talking to Chris, Rachel, learning how we can make money investing in apartment buildings. Guys, before the break, so Rav can invest with you guys. I can be a partner, and 50-50. The exit strategy is to get my minimum investment of $100,000. Generally speaking, I mean, every case is different, but that's kind of what you're looking at. I can get that capital out. The goal is within 5 years. Some may be at 3. Some depends on how quickly this appreciates and our interest rates to pay down the mortgage and all that kind of good stuff. But then once I'm paid back, now it's just kind of infinite returns because it's just spitting out money like a bank machine, and I can pass it off, and it can be legacy wealth if you want, or maybe I'm bought out of it, or whatever the case. Maybe we decide collectively to sell it to a big REIT. So there's many different kind of exits. But let's just say, the first 1, 2, 3, 4, 5 years, if you were to put a percentage, analyzed percentage on it, what would you say in terms of return on my investment?
Yeah, so think on the cash return. Think in the ballpark of 4 to 6%. It does change a little bit from deal to deal. And then in the equity portion of that, on the initial projections, we'd look at that bumping up into the mid-teens in combination with the cash return and then the equity component. Yeah, mid-teens is where you'd land.
And we're looking at that for the investor, or then we split that?
No, that's for the investor, already split.
For the investor. Okay, so really you're looking at 25 to 30%, and we split that, Rav splits that with you guys. But again, the goal is to get the capital out, and now we have this. And maybe now we could do another one, What is the risk, the downside that you see? Well, talk about why you love this asset class as well, first of all, and then what would be, risk that you would see as well that people need to look carefully, because there's other people that are offering apartment building investments. And so what should we be looking for when we're looking at something like this?
Well, from a risk point of view, I can speak to what my husband, Mr. No, said to me originally and how I addressed it. Neil thought that apartment buildings are super risky, and we originally wanted to do these apartment buildings on our own, and we could just never really kind of pull the trigger. And one of the things that we realized was that these projections and these estimations are all fantastic, but if you don't have kind of the three components of a solid operation plan, a solid renovation plan, and team, and then have a financing strategy, then these are all just projections that are probably very easily missed. So you have to have the right team in place to be able to actually deliver. Because like I said, this is a business, and knowing what to do, when to do it, and how to do it, and have a team in place for the day to day, that is where the big differentiator is. So yes, there's a lot of people out there that are doing apartment buildings, but we realize that we weren't satisfied with what they bring to the table. So we couldn't find a team that we trusted, so we created our own, or merged with people we trust.
That's a great point. There's a lot of moving parts in this asset class. This is one of the ones where you don't graduate into, but generally speaking, is not the first thing a real estate investor does: buy apartment buildings, right? And why is because it's complex. And so what you're saying is make sure you have the right team, because there's a lot of moving parts. You can one person can focus on this, another person can focus on that. You come back to the table, you have a discussion. So that's a great point. Yeah. Make sure that the right team is in place. Anything else, Chris, you would say?
The team and the structure and the operational plan, 100% agreed. And the other thing that's why we love this asset class, these residential units. We know that supply and demand is very askew in the GTA. And part of the reason why we like these 10 and 20, 30 unit buildings is the demand for those living spaces is so steady, right? And if anything, it's increasing over time. So, and we saw this during COVID. I mean, you couldn't get a better case study. A once in a century pandemic comes along. The demand and the necessity of these living spaces, let alone nicely renovated, fully functional, beautiful living spaces, it didn't wane at all. We were placing tenants throughout the entire thing into these, into these very functional, well-renovated units, which is, again, just mentioned earlier, these asset classes perform well during pullbacks in the market, but also during a once-in-a-century pandemic, they do extremely well.
Yeah. No, great stuff. Okay, so let's talk about formula. Before we do that, there's something that's thrown out there called the capitalization rate. Obviously, that's the amount of time that it takes to, and so on. So we won't necessarily go down that route. I want to look more, for the purposes of this, a cap rate also helps us determine the area, correct? Like, how do I know what the value of this car wash is beside this bakery, beside this apartment building? And so we use something that's called a cap rate, correct?
Yeah, exactly. And to your point, that cap rate changes from, let's say, city to city. It's not necessarily, restricted to the city, but a little region like a city. So yeah, the cap rate is a general metric by which we can establish the value in a given area. Yeah,
it's an industry, standard, kind of like, we judge, when it comes to condominiums, we look at it, price per square foot. When it comes to apartment buildings, we look at it, the value by taking the income that comes in after all expenses, not including any mortgage. We look at the operating income, we divide it by this cap rate, and it's understood that spits out the value, correct?
That's exactly.
Okay, so Rachel mentioned, something that we can do here. So if we have our income here, and let's say we've increased, like a tenant has moved out, or we've done some renovations, and now we've increased that operating income just on one unit. Let's just talk about one unit, and then we can times it by the sweet spot of 20 or 30 or whatever you want. So give me a number here, just for an example. We increase the income by what?
Yeah, so to your point, somebody moves out, we go in and renovate for, let's say, $30,000, and we increase the rent per month by $400, or around $5,000 per year.
$5,000 per year, okay? Yeah, make number $4,800, but to make a number simple, we've increased by 5K in that one year by putting in how much money did you say?
30,000.
30,000. And this is where, and God bless them, I respect our elders. We need to respect our elders. We need to learn from our elders. But I probably am going to think twice if they tell me to put my money under the mattress. Or I may think twice, not that it's wrong, I wish I would have listened to them right now, to pay off your mortgage as quick as you can, as opposed to using it as a bank machine. And us investors, we often do that. The other thing that they wouldn't understand per se, and again, with all respect, why in the world would I spend $30,000 just to get $5,000? That doesn't make any sense. I'm going to break even after 6 years or so, maybe. But that's not how the way it works, because you're saying we divide it by a cap rate. And in this case, what are we using and what city would we be in? So we take this 5K, so it's $400 a month that we've increased the rent. That equals $5,000. You divide that by the cap rate, and what would that cap rate be? And give me the city.
Yeah, so think example cities would be Hamilton, Barrie, Oshawa. I think a cap rate of 5%.
5%.
There's lots to be said about that, but let's use that for now.
Okay, so 5%, and then that will spit out a value. This is from my real estate days, brokerage days, when I had to take all the courses. We called it ERV, this formula. It was kind of ERV, because you can also take your 5K, divide that by the value if you see it on a listing, and that'll spit you out the cap rate. And now you know, is that value the right value based on a cap rate? Because if we're in Hamilton and the cap rate, this says 2%, that's a different story. If it says 10% and it's reversed, buy it really quick. So anyways, ERV, income, rate, value is the way that I remembered it. Might be an option for you at home as well. But Chris is telling us 5K divided by 5% equals
100,000 in extra value in the building.
So $100,000. We put in 30,000.
30,000.
Okay, so minus the 30K. So we've profited on one unit $70,000. And if we're going to have 20 units, what's that?
Well, we're getting up to 1.4 million across 20 units.
1.4 million. So this is what you're doing. This will take time, 3, 4, 5, 6, 7, whatever years. Or if we were able to do them all, we increased by $1.4 million. Now I understand why you can refinance and pay little old Rav and friends back. Yeah?
Exactly, right. So that 1.4 million lift, you can refinance. You can do two things. If you were to sell, you'd recognize that 1.4. If you were to refinance, you'd recognize 60, 70% of that 1.4 right back into your pocket, right?
Yeah. Guys, it's fantastic. Rachel, any final thoughts? Time flies when we're having fun and I'm being nurtured. We'll have to have you guys back. But anything, Rachel, that you want to share?
I just wanted to point out that why I love this asset class is yet another reason that we're not really at the mercy of what's happening in the residential real estate market. Home prices go up and down. And with apartment buildings, we are not really feeling that volatility. We're really looking at these dollars and cents that you're illustrating here, and that really dictates the growth. So we're in control, not the market.
Yeah. Well said. Well said. Guys, thank you so much for taking your time out and being on the show, educating me, educating the viewers. It's truly a blessing. Thank you.
Thanks, Rob. Appreciate it.
Yes. And thank you guys for watching. Without you, we would not have a show. To watch this one again, make sure you go to everydayinvestor.com. You can watch this show. You can watch any past shows. And then make sure you also subscribe to our YouTube channel. Hit like, subscribe, all that kind of stuff so that you can get it right inside of your inbox. We'll see you next week. Same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.